They were college roommates. Same university, same degree, same graduation year. They even got their first jobs in the same city, earning salaries so close it was almost a running joke between them. At 28, they both had $50,000 saved. Same discipline, same sacrifice, same starting number. And they both made a decision about what to do with it in the same month. One of them bought a rental property, a decent two-bedroom in a growing neighborhood. She put the $50,000 down, got a mortgage for the rest, found a tenant within 6 weeks, and felt, for the first time in her adult life, like a real investor. She had something physical, something she could drive past, something she could point to. The other one opened a brokerage account. She put all $50,000 into a low-cost index fund tracking the broad U.S. stock market. No tenants, no mortgage, no property to visit, just a number on a screen that she mostly ignored, aside from adding to it every month from her salary. 20 years later, they met for dinner, same restaurant they used to go to when they were broke students. One of them had built significant wealth through her property portfolio. She was proud of it, and rightly so. She had worked hard, managed tenants, dealt with repairs, refinanced when rates were favorable, and made smart decisions along the way. The other one had barely thought about her investments in 2 decades. She had simply kept adding to the account every month, reinvested every dividend, and left it alone. She had never unclogged a drain or chased a late rent payment or worried about a vacancy period. The numbers at that dinner surprised both of them, not in the way you might expect. And the conversation they had that night about what actually drove the difference, what each path really cost, and what the math looked like when you stripped away the assumptions, is exactly what I want to walk you through today. The same way they'd debate 2 cars. Pick the one with the better specs and drive it. But these are not equivalent instruments with different returns. They are fundamentally different financial structures with different risk profiles, different capital requirements, different tax treatments, different liquidity characteristics, and different demands on your time and attention. The question is not which wins in the abstract. The question is which wins for you, given your capital, your temperament, your time, and your understanding of what each path actually requires. And to answer that honestly, you need to strip away the mythology that surrounds both of them. Because both sides of this debate carry powerful myths, and those myths are costing people real money. Promise. I'm going to show you the actual math behind both paths, the hidden costs that most comparisons leave out, the psychological traps that lead people to the wrong choice for the wrong reasons, and the framework that will let you look at your own situation and know, clearly, not emotionally, which direction makes sense for you. The numbers in this are going to surprise you. Some of them will challenge things you've believed about investing for years. Pay attention to those moments especially. They're the ones that matter. The principles. Principle 1. The headline return number is almost always misleading for both assets. When people compare stocks and real estate, they usually start with a return figure. Stocks have historically returned around 10% annually in the U.S. market before inflation, roughly 7% after. Real estate, people say, has returned somewhere between 3 and 5% in pure property value appreciation historically. On that basis, stocks win easily, and many people stop the analysis there. But here's what most people miss. Real estate investors don't just earn the appreciation on the property, they earn it on the entire value of the property while only putting down a fraction of that value. That is leverage, and leverage changes the return calculation completely. Consider this. You put $50,000 on a $200,000 property. The property appreciates at 4% annually. In year 1, that appreciation is $8,000 on your $50,000 investment. That is a 16% return, not 4%. You earned the return on the full asset while only deploying a quarter of its value. This is the number that real estate advocates are actually talking about when they cite impressive returns, even if they don't always explain the mechanism. The leverage amplifies the gain. The psychological insight here is important. Leverage feels like a strategy. In a rising market, it is enormously effective. But leverage is not free. It amplifies losses with the same force it amplifies gains. A property that falls 20% in value on a 25% down payment has wiped out 80% of your equity. That number rarely appears in the promotional version of the real estate return argument. Principle 2. The true cost of real estate ownership is substantially higher than most people calculate. This is the principle that changes the most minds when people actually run the numbers carefully. The purchase price of a property is the beginning of the cost, not the total cost. There are transaction costs on entry, typically 2 to 5% of the purchase price in closing fees, inspection fees, and legal expenses. There are ongoing carrying costs, property taxes, insurance, maintenance, and repairs, which typically run between 1 and 3% of the property's value annually when averaged over time. There are vacancy periods when the property produces no income, but the mortgage still requires payment. There are management costs if you use a property manager, typically 8 to 12% of monthly rent. And there are transaction costs on exit. Real estate agent commissions alone typically run 5 to 6% of the sales price. When you add all of these costs up and subtract them from the gross return, the net return on a typical rental property frequently looks meaningfully lower than the headline appreciation number suggests. It gets worse. The maintenance costs in particular are systematically underestimated because they are irregular. Years go by with nothing major, and then a roof needs replacing, or a heating system fails, or a foundational issue appears, and a single repair bill can consume months or years of net rental income. The investor who plans based on average costs and then encounters a major expense in year 3 has a very different actual return than the spreadsheet she built before buying. The hidden cost that nobody talks about clearly enough is time. Real estate is not a passive investment in the way that a stock index fund is passive. Even with a property manager, you are a business owner. Decisions require your attention. Problems require your judgment. Tenants, regulations, insurance claims, refinancing, all of it demands something from you that a stock portfolio does not. That time has a value, and when you factor it into your true return calculation, the comparison shifts further than most real estate advocates would prefer. Principle 3. Stocks have a hidden advantage that barely gets discussed, and it is frictionless compounding. The most powerful force in wealth building is compounding, and compounding works best when it is uninterrupted, automatic, and free of transaction costs. A stock index fund compounds in a way that is nearly frictionless. Dividends are automatically reinvested, there are no maintenance costs, there is no vacancy, there is no negotiation, no tenant, no repair. The returns compound on themselves continuously, and the only cost is a small annual management fee. For index funds, often less than 0.1% per year. Real estate compounds too, but it compounds with friction. Every transaction costs money. Refinancing costs money. Repairs interrupt the compounding. Vacancies interrupt the income. And unlike a stock portfolio, you cannot sell 5% of your property when you need liquidity. You sell it all, pay the transaction costs, and then decide where to redeploy the capital. I'm not done yet, because there is a compounding advantage to stocks that even experienced investors frequently underestimate, and it is the tax treatment of unrealized gains. When a stock you own increases in value and you do not sell it, you owe no tax on that increase. The gain sits inside your account, compounding on itself, untouched by the tax system, until you choose to realize it. In a retirement account, it may never be taxed at the capital gains rate at all. This ability to defer and control the timing of your tax liability is a genuine return enhancer that does not show up in the headline return number but compounds significantly over decades. Real estate has its own tax advantages: depreciation deductions, mortgage interest deductibility, 1031 exchanges for deferring gains on property sales. These are real and meaningful, but they require active management, professional advice, and ongoing administrative attention. The stock investor's tax advantage requires almost nothing. Principle 4. Real estate has a genuine psychological advantage that is worth taking seriously. Here is something that the purely mathematical case for stocks tends to overlook, and it matters more than the finance-first crowd usually acknowledges. Most people do not hold a diversified stock portfolio through a 40% market correction without doing something costly. They watch the number on the screen fall, they feel the loss acutely, and at some point, usually near the bottom, when the anxiety is highest and the news is worst, they sell. They convert a temporary paper loss into a permanent real one, and then they miss the recovery. The research on this is consistent and sobering. The average retail investor earns substantially less than the market return over time, not because they chose bad investments, but because they made emotional decisions at the wrong moments. The behavior gap, the difference between the investment's return and the investor's return, is real, it is large, and it is driven almost entirely by the human response to volatility. Real estate investors, by and large, do not behave this way, and the reason is largely psychological. A property is physical. It does not display a real-time price. You cannot see it losing 30% of its value on a Tuesday afternoon because there is no screen showing you that number. The same market forces that would produce panic selling in a stock portfolio produce in a real estate investor nothing, because the information is not presented in a way that triggers the same emotional response. The property investor who holds through a market downturn and emerges with her asset intact has not made a more sophisticated decision than the stock investor who panicked. She has simply been protected from her own psychology by the illiquidity of her asset class. This is a genuine advantage, and for investors who know they are susceptible to emotional decision-making under stress, which is most investors, it deserves serious weight in the comparison. Principle 5. The right comparison depends entirely on the capital you have and the return you can actually access. Here is the principle that resolves most of the stocks versus real estate debate, and it is the one that almost never gets stated clearly. For investors with limited capital, say under $100,000, the stock market offers something real estate does not: full access to market returns from day one with no leverage required, no debt, no property management, and complete diversification. A person with $20,000 can invest that entire amount in a broad market index fund and begin earning market returns immediately. A person with $20,000 cannot buy a meaningful investment property in most markets without taking on substantial debt at terms that may not be favorable, in a neighborhood they can afford that may not appreciate as well as they'd prefer. But for investors with sufficient capital and access to favorable financing, real estate's leverage advantage changes the comparison significantly. The ability to control a $200,000 asset with $50,000 of your own money in a rising market with positive cash flow from rental income is a return structure that stocks cannot replicate at equivalent capital input. The honest answer to which is better is almost always it depends on how much capital you have, what financing you can access, what market you're in, and whether you are willing and able to manage the operational demands of property ownership. But here's what most people miss. The investors who build the most significant wealth over their lifetimes are frequently the ones who do not choose between these two paths. They start with stocks because it is accessible at every capital level. They build capital. They deploy that capital into real estate when the numbers work and they have the bandwidth to manage it properly. And they continue holding their stock investments in parallel. The either-or framing of this debate is itself a trap. The question is not which one to pick, it is how to sequence them intelligently given where you are right now. Principle 6. The shocking math is in the long-term comparison with costs fully included. Let's bring this to a real number comparison, because the math is where the mythology dies on both sides. Take our original scenario. Two investors, $50,000 each, 20 years, different paths. The stock investor puts her $50,000 into a broad market index fund and adds $500 a month from her salary. At a 7% annual return after inflation, over 20 years, she ends up with approximately $580,000. She paid minimal fees, she had no debt, she did almost nothing except not panic. The real estate investor uses her $50,000 as a down payment on a $200,000 property. She earns rental income, but after mortgage payments, property tax, insurance, maintenance, and occasional vacancy, her net cash flow is modest, perhaps $200 to $300 a month in good months, zero or negative in months with repairs. She also adds $500 a month to a savings account for property expenses. Over 20 years, assuming the property appreciates at 4% annually, it is worth approximately $430,000. She still owes the remaining mortgage balance, perhaps $120,000 after 20 years of payments. Her equity is approximately $310,000. If she sells, she pays real estate agent commissions and closing costs, roughly $25,000. Her net proceeds are approximately $285,000. But here's the full picture. Her total cash invested, the down payment, the monthly savings for expenses, and direct out-of-pocket maintenance over 20 years was substantially higher than the stock investor's total contribution. And the time she invested managing the property has a value the spreadsheet does not capture. The stock investor in this scenario comes out ahead in raw numbers, but the real estate investor built her wealth with leverage and had a tangible asset that anchored her financially through every market cycle without requiring her to watch a screen over the previous 2 decades, without requiring her to watch a screen. Both paths worked. The math surprised both of them at that dinner, and the lesson was not that one was right and one was wrong, it was that each of them had built something real, and neither of them fully understood what the other path had truly cost or truly produced until they sat down and did the math honestly together. Return to the quiet street. Same 2 houses, evening light now, warm and still. Remember those 2 women. Same start, same city, same $50,000, same month. Here is what the dinner conversation actually revealed. The real estate investor was wealthier than she looked on paper, not just in money, but in the confidence, the knowledge, and the operational skills she had built over 20 years of managing a real asset in the real world. She understood leverage, financing, cash flow, and property markets in a way her counterpart did not. And her wealth, while not larger in numbers in this scenario, was diversified in a different dimension. She owned something physical, something that could not go to zero, something that had given her rental income through every stock market crash of the previous 2 decades without requiring her to watch a screen. The stock investor was wealthier she looked too, not just in the final number, but in the time she had not spent, the weekends she had not given to property management, the cognitive space she had not consumed with tenant problems and maintenance decisions. She had compounded not just money, but freedom, and the portfolio she had mostly ignored had built something significant in the background of a life she was living fully. Neither of them had made the wrong choice. Both of them had made an incomplete comparison before they made it. The real lesson from their 20 years was not that stocks beat real estate or that real estate beats stocks. It was that the investors who build the most significant wealth are the ones who understand both paths clearly enough to use each one at the right time with the right capital for the right reasons, and are not seduced by the mythology of either. The shocking math is not that one path wins and the other loses. The shocking math is how much better both paths work when you understand them fully before you choose. The question was never stocks or real estate. The question was always, do you understand what you're actually buying? If this changed how you think about investing, share it with someone still arguing about which is better. Subscribe. There's more of this coming.